Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Jim Welsh, Marko and Tracy Shuchart. Jim's going to talk to us today about the 17-year cycle in U.S. markets. He's put out a very detailed piece on this. So I'm really looking forward to that discussion. We're going to talk with Albert about the Fed. Does the Fed have a backbone? We've seen with CPI and PPI prints, really wondering whether the Fed can stay the course with their policy. And then with Tracy, we're going to talk about how low Natgas can go. We're at levels we saw in 2020, but we're at levels now we haven't seen since the late 90s. And so we're just wondering how low can that go and what's driving price there. So Jim, thank you so much for joining us. It's really great to have you on, and welcome from Southern California.
Well, thank you so much, Tony. It's great to join you and Albert and Tracy and, have a great conversation and provide hopefully some very good information to your listeners.
Good. Looking forward to it. Before we get started, I want to let you know about a new free tier we have within CI Markets, our global market forecasting platform. We want to share the power of CI Markets with everyone. So we've made a few things free. First, economics. We share all of our global economics forecasts for the top 50 economies. We also share our major currency forecasts, as well as Nikkei 100 stocks. So you can get a look at what do our stock forecasts look like. There is no credit card required. You can just sign up on our website and get started right away. So check it out. CA Markets free. Look at the link below and get started ASAP. Thank you. Okay, you've got a really interesting piece out about the 17-year cycle in U.S. markets. So I noticed this in a tweet that you put out earlier this week showing the S&P 500 and the low and the change over time and what happened. So we see a lot of historical analogs in markets. People pick the 30s or the 70s or the 20s or whatever. So can you walk us through your thesis and help us understand how this applies to us right now in 2024?
Well, it's pretty straightforward, Tony. If you go back to 1939, 56, 73, 90, and 2007, the S&P has recorded a high in each of those years, followed by declines of at least 20%. Obviously, in 73, the decline was around 50%, 2007, 57%. And the thing that adds some validity to it, I believe, is that the reasons for those declines varied. It wasn't just one reason consistently. And to me, that adds, a factor that, you could say, well, it always happened because of this. And right now, maybe that isn't here. So geopolitical risks, I think there are downside risks to the economy that most people aren't acknowledging. As we know, for much of the last 18 months, people were worried about a recession. Those same people now don't think a recession is possible.
Right.
We look at investor sentiment is really high. I saw a chart showing that almost 50% of all the options traded these days are zero dated, meaning they expire in less than 6.5 hours. So a high degree of speculation. So I think there's a lot of reasons why, in addition to, it happens to be 17 years after 2007, for people to be vigilant in terms of identifying a high that potentially could be followed by a fairly meaningful decline, maybe not just in 2024, but 24 and 2025.
Okay, so what are some of those factors? You mentioned geopolitical risk, and we've talked about this. Tracy and I just talked about this last week, how, geopolitical risk seems to be underpriced. With NERP and ZERP, there really is no consequence aside from the nominal cost of something for geopolitical risk, right? Where when you have actual interest rates, it costs you a lot more than, your initial sunk cost, right? So there's geopolitical risk. There's commercial real estate, which a lot of people talk about, right? Yep. And so what are some of the other things that, there may not necessarily be direct causality, but what are some of those other risks that you're seeing that are swirling out there?
Well, you touched on some of the more obvious ones. I think one of the risks that we see, and it's kind of twofold, financial conditions have eased significantly, but there's two types of financial conditions. They're market-based financial conditions, which comprise the stock market measured by the S&P, Treasury yields, the dollar, yield spreads. Those have come down, or financial conditions have eased significantly and are back to about where they were at the beginning of 2022 before the Fed started hiking. So there's also Main Street financial conditions. Now, the easing of market-based financial conditions have brought mortgage rates down, which is going to be helpful for a period of time for housing. But for most other rates, so if you're a small business, you haven't seen any relief. If you're a consumer with credit card debt, buy now, pay later stuff, any personal loan, auto loans, you have gotten zero relief in terms of interest expense and cost and the burden that implies.
I have
So my
kids with
take
student
here,
loans, and their loans are now at double-digit rates, right?
yes,
And so, it's the people with the least money who
right.
end up paying for this.
Right. And so excess savings has been a big component in terms of why the economy's had legs in the face of the biggest tightening in 40 years, biggest increase in lending standards in 40 years. The San Francisco Fed has attempted to pin this number down. I've seen various estimates. A few months ago, they said, well, at the end of September, it's around zero. In December, they said, you know what, it looks like it's 430 billion or so. My point is, it's not inexhaustible. And
Correct.
to your point, Tony, you look at delinquency on cars, loans, credit card delinquencies, and so forth. We're seeing stress building from the bottom up. And one of the things that's been helping keeping consumers spending strong is obviously equity values being increased and so forth. So the other point I would make is people went nuts a year ago when the yield curve inverted. And after 2 quarters of negative growth in the first, half of 2022, everyone was on the band. Oh my God, we're in a recession. We're about to have one. Now, I pointed out that job growth in the first half of 2022 was like north of 350,000, which meant there was no recession. But the point that I think many people overlooked, Tony, was the average lead time between an inversion and a recession starting is 19 months. Well, the curve inverted in July 2022. What's 19 months? That's January 24. And anything that has an average means you've had some instances, obviously less, some longer. So to me, we're just entering this window, I think, over the next 6 months, where we're likely to see, I think Wall Street's surprised that the economy is going to slow more than expected. And the last thing to go is the labor market. So people say, well, look at the job market. Well, in fact, job growth has slowed down significantly.
Yep.
Quit rates coming down, hours worked, a very significant piece of the labor market. Yeah, we had more jobs, but if you're working an hour or two less a week, what's happening to your paycheck?
Right.
So anyway, I think there's a lot of people who were on the recession bandwagon a year ago. Now they're not, just at the point in time where I think the risk of a more meaningful slowdown is higher. And lastly, I'll mention the Fed funds rate is at a restrictive level. And the Fed and Chairman Powell and what I call the patient doves are comfortable keeping it at the current level for longer because the economy, in fact, has been doing okay. But the reality is it is at a restrictive level. And the longer it's maintained, the impact from financial conditions on Main Street, I think, are going to come home to bear.
Yeah, the economy has been doing okay officially, right? Like if we look at the official data, it's fine.
Right.
Unofficially, there are pockets where it's really concerning. Jim, what about the people who are going to watch this and go, oh, perma bear? Like you can always find a perma bear. Like you're not a perma bear, are you?
I have not. I mean, in 2022, in the first half of last year, when people were worried about a recession, especially after the regional bank thing, I'm like, no, we're not in a place where we're going to have a recession. I expected growth to slow in the last half of last year. It did, not as much as I thought it would, but that doesn't negate what I believe are the downward forces that are going to show up and intensify on the economy. One thing, Powell talked about a soft landing when they first raised rates in March of 2022. He said, well, you go back to 65, 1984, 1995, soft landing, so it can be done. Wall Street has, of course, embraced the 95 episode with both arms. The thing I've pointed out repeatedly is if you go back and you look at lending standards, the one thing that didn't happen in those 3 years was lending standards weren't increased. Well, we've seen just the opposite over the last 18 months. So again, I just think that the probability I'm a contrarian at heart. So when everyone else was negative, I pointed out things why the idea of a recession was unlikely. Now everyone is kind of sanguine about the economy. And I think there are legitimate reasons to have a level of concern about the next 6 to 9 months.
I'm cautious. I'm always cautious. I'm a skeptic. I can't help it, right? So before we dive into some charts, Albert, what are you thinking about? Where do you think we are? Do we need to be cautious right now, or do you think we're kind of going to the moon?
I think it would be silly not to be cautious. I mean, we're looking at all-time highs and, in the market with only a few handful of stocks driving everything up. I mean, it would be silly not to be cautious at the moment. Nothing makes sense fundamentally, in terms of why and how this rally happens. And, from my repetitive warnings, watching the Fed and the Treasury act, it's like, I mean, they crush oil, pump bonds, rally tech, rally the market. That's not sustainable. I don't care what anybody says. Everyone talking about this melt up to 6,000 or 8,000 or whatever thousand they want to do in the market. It's just not sustainable atmosphere right now. And Jim's right.
8,000 is not a melt up. That's a rocket ship, right? Tracy, what are your thoughts on this? I mean, we've seen energy prices crushed, right? And so. What do you think? Like, is this sustainable where we are right now? Okay, you're on mute.
I'll push back. I mean, I've said higher for longer for oil prices, and we have been higher for longer. I mean, granted, we're not above 100. Above 100 is just not sustainable globally, right? Because it hurts emerging markets. It's just not sustainable. It's not realistic. But if you look at, the price of oil over, the last 50 years, even inflation adjusted, we're still relatively high. It's $30 a barrel is basically what we've been trading in at if you've taken an average. And so it is higher for longer. And so these prices are 77 is and 82 for Brent. It's nothing to scoff at. Yeah. Granted, not gas prices are way down, but aside from that, what I worry about, and I wanted to ask Jim about is, are you worried about we're already seeing Europe in a recession? I would venture to say they're in a recession, particularly Germany, right? And then we have this commercial real estate problem in the US, which seems to be manifesting itself also in Europe. And so what are the greater impacts to the US economy if, globally these banks have problems? How much does that bring us down?
Well, I agree with you that commercial real estate, I think, is going to become a bigger problem as we get later this year into next year. I can't remember the exact number, but there's a lot of money coming due. I think it's over $900 billion of loans that have to effectively be renegotiated. And they're going to do everything they can to delay. I can't remember, I'm just forgetting the expressions, delay and what. Anyway, there are a couple of witty expressions. So my point being is there's a work through period, but it's not going to work for everybody who's on the ledge. Small banks have an inordinate amount of exposure. Powell even acknowledged that there will be, closures and so forth. So to assume that that's going to go smoothly without any bumps seems wildly naive to me. And I think the risk here, Tracy, is if indeed the economy slows as we get past mid-year progressively, and you start to see a modest uptick in unemployment, which will have a dampening effect on consumer sentiment, all of a sudden you get one of these extra events take place. That's how you go from a slowdown to a recession, is you get something else that piles on at a moment of weakness. And I think that there's a very high probability that is exactly what's going to happen. So I agree with you. In terms of Europe is in a recession, yes. So global growth is weak as well. China is struggling, obviously.
Japan struggling.
Yeah, I mean, so those are all tidal forces. It just takes time for all that to manifest itself. And we're all in the, hey, let's look at a 30-minute chart,
right?
And make a decision.
ADHD markets right now.
Love
it. Yes, let me take another Adderall. I'm ready. No, the one thing I'll add on to Tracy's comments. If you look in the 70s, when oil prices went from $3 a barrel to 39, and then obviously in from 2004 to 2008 when it got up to 147, the response was a huge increase in investment by energy companies. I mean, I think in the 70s it went up 500%. Well, what happened? You got more supply. By 1985, oil went from 39 and 79 to 10. And we know what happened after the shale revolution. Oil went from 115 to under 60, and, obviously lower during the pandemic. My point has been is this is an argument of why inflation potentially will remain at a higher level, because given a decent level of economic growth, we're going to have less oil in the future to sustain it. And the idea that we're going to transition away from oil so significantly in the next 10, 15 years, so you don't really need that much oil, I think is wildly unrealistic. So I think that's one of the factors that inflation might have a higher floor than it has in the past from the energy contribution.
Yep. And we've talked about that several times on this show with Tracy about how higher interest rates have forced wind farms to close and wind investment to subside and solar farms to close and solar. So higher interest rates almost force us back into crude oil and nat gas, right? So I wanted to ask you a question, Jim, on you mentioned $900 billion of commercial real estate. Now, I know it's hard to believe, but I'm old enough to remember 2007 when the first reports came in about the housing bubble. And I think it was a Deutsche Bank report that said the worst exposure would be $200 billion. That was worst case. Okay.
Right.
And it ended up being obviously a lot more than that. So you're saying $900 billion, but is it possible that it could be double or triple that in the next 12 to 18 months?
Yeah. I mean, again, going back to 2007, and I have a report I'm happy to send out to anybody who would like to read my analysis from 2007 and 8, jimwelshmacro at Gmail. And what I found was in March of 2007, lending standards increased significantly. And my conclusion was, hey, the Fed isn't going to do anything with the funds rate. But the Fed is the spigot, the banks are the nozzle, and the banks have just tightened monetary policy. And guess what? When the economy slows, unemployment goes up, what are they going to do with lending standards? And I also had shown a chart showing that median home values relative to median income had gone from the historical average from 65 to 2002 of around 3 to 1, which made sense because banks used to limit, you can't have more than 1/3 of your income going for mortgage, and you do the reciprocal, 1/3 becomes 3 to 1. Well, it was up to 4.5 to 1. So back in 2006 and 7, I was saying housing prices could fall by 20% just to bring this ratio from 4.5 back down towards 3. I think a similar analogy can be brought about offices, because they're going to delay as long as they can, when the music stops. But if the economy slows in a meaningful way, and I think there are reasons, I'm in the camp that we're on the cusp of a secular bear market in equities, comparable to 1966-82. And I've got a piece that explains all the different reasons why. So my point, I guess, is that this commercial real estate problem is being ignored at this point in time. And to Tracy's point and your point, hey, it's going to come back to the front burner. And when it does, things always come out of the woodwork. There's always more over-leveraged players than we realize. And then the ripple effect all of a sudden engulfs more institutions and entities. So to me, I mentioned the 17-year cycle. Well, there's a 2-year cycle. The S&P topped in January of 18, February of 20, January of 22. And so my expectation was, hey, looking for a top in February of 24 based on that cycle is also reasonable. So I think a lot of things are coming together in my mind that, to Albert's point, hey, this is unsustainable, what's happening. The level of speculation is a big, bright yellow light flashing, but it can go on for a while until the music stops. And when it does, it'll do it, I think, kind of in an abrupt way.
Hey, I'd like to make sure you know that you can access our AI-driven market forecasting tool called CI Markets for free. No strings attached, and it does not require any credit card information. Go to completeintel.com/markets to subscribe. CI Markets is the perfect addition to your analysis toolbox. This free account includes Nikkei stocks, major currency pairs, and global economics. Of course, we offer much more in our paid account, but this lets you experience CI Markets before making a financial commitment. CI Markets uses the power of AI to help you make better trading and investment decisions. It's absolutely free. Again, go to completeintel.com/markets to subscribe to CI Markets free. Jim, you talk about 2007, 2009, and I've got a chart from your article looking at the S&P from 2007 to 2009. Can you talk us through that? It topped at 1576 in 2007, and then it bottomed at 666 in 2009.
Yeah.
It's kind of quaint to see an S&P 500 numbers in the hundreds instead of the thousands, right? But can you walk us through that?
Well, basically, again, this was one of the tops of the 17-year cycle. And there were legitimate reasons why a bear market was likely. I thought we would have a recession at the end of 2007 going into 2008. And that as things evolved, that the housing problem would become a bigger problem. It would engulf the banking system in a more meaningful way. Liquidity was drying up, and all of it snowballed to obviously the financial crisis. So, the 17-year cycle isn't going to maybe fill in the blanks and the details of what will lead or provide a reason to sell. I mean, I'm a technician and a fundamentalist. There aren't too many people combine both, all right? Technicians sometimes say, oh, look at the sentiment, man, there's so many bulls. But you have to have a reason to sell for markets to go down. And that's where we are right now. There's a vacuum of reasons to sell. We've seen in recent months, Wall Street's embraced, we don't have a recession, don't have to worry about that. And the Fed's going to be cutting the funds rate 6 or 7 times, all right? So we've seen one pillar pulled out this week with the CPI and PPI. Okay, so they're not going to cut 6 or 7 times. We may have to wait, oh my God, to June, but they are going to be cutting. But more importantly, the economy is growing. So the next, to me, vulnerability will come when and if we see more signs of economic slowing. And so, that to me is the next shoe to drop. The retail sales number came in yesterday, was weak. There's seasonal adjustment factors, but they also revised December down. Last year, retail sales in January was very strong, which might have contributed to the change in the seasonals. But people last January spent money they had gotten off on their gift cards. So did that change? Well, the weather was really extreme in January. So I think that had some impact on that. But I wouldn't take that at face value. At the same time, I wouldn't ignore it either. No. And the bulls are willing to ignore it. It's like, okay, it's just a question of when we start to see, I think, consumer spending slow. And there's enough mud in the water that I wouldn't say, oh yeah, that's proof. But I think it's coming. So
yeah, the revisions are too frequent, and I've actually trademarked. I'm like, the phrase always wait for the revision, right? Because we're in that place where the revisions are too dramatic, too frequent, right?
Yeah.
So it tells me that the government statisticians, they actually don't know what's going on. We have no idea.
They use 5 years of data.
Moving markets. Yeah. And they're not real. Nobody really thinks they're real. But we're in a bigger sucker moment in markets where people say, oh, CPI came out and I believe it, or I believe that other people believe it, so I'm going to trade on that number, right? Or GDP came out and I believe that other people believe it, so I'm going to trade on that number. And that's fine in a very short term, but over the long term, we have to be really careful about how we're positioned when we don't trust those numbers.
I agree. And that's why, to me, looking at some of the longer term indicators like the yield curve, the leading economic index, and if you will, a dose of common sense, in terms of what's happened with lending standards and rates, the impact on the economy. I think the seasonal adjustments, Tony, are done like with a 5-year window. And so the extreme nature of what happened to the data, during the pandemic and the response, I think these guys are legitimately struggling with
They are.
how to deal with that.
Yeah.
And some of the old methods that they've used probably are struggling as well to come up with the right seasonal adjustment.
Yeah.
So
They're
it,
not
it
superhuman.
underlines the point that you're making is
Yeah.
that we should, and the other thing is the response rate on things like the employment report, the JOLT survey,
Terrible.
it has dropped very significantly. So
It's like 30%.
again, common sense makes sense.
Yep. So Jim, let's look at one of those indicators, the advanced decline line. This is in your report. Can you talk us through what you're seeing in the advanced decline line and the negative divergence on that?
Okay. The AD line, the advanced decline line is just basically saying how many stocks went up today, how many went down. Let's subtract those two numbers and then create a running total.
Yep.
In a healthy market, you obviously consistently have more stocks going up than down. So the advanced decline line goes up. And conversely, during a bear phase, you got more decliners than advancers. Typically at highs, important highs, what will happen is the S&P will make a higher price high, but the AD line will make a lower high, showing that there's selling going on underneath the surface and that there's weakness starting to creep into the market. The AD line made a new high yesterday. All right. I think one has to take that at face value. That's a healthy sign. That's why my belief has been is we're setting up for, I think, a 3 to 7% pullback. And that nature, if and when that shows up, will tell us a lot about the more intermediate term. But the reason why this is significant, Tony, is like in 1928, 29, there was a divergence. Prior to the 87 crash, there was a divergence. 2022, there was a divergence. 72, 73. So this is something that has identified numerous very significant highs in the market. It's just one more piece of evidence that I use to try to come up with, a greater conviction in terms of what I'm expecting the market to do. With the new high in the AD line, that's why, given everything we've said, I still think near term, the probability is more like a 3 to 7% pullback, rather than, oh my gosh, we're really going down.
Big one.
Big time. Yeah. As Red Fox used to say, it's the big one.
Big one. I'm coming to see you. What was her name? Elizabeth. So that's my ringtone, by the way. So the Sanford & Son theme song is the ringtone on my cell. Just so.
Okay.
So so Jim, we've seen the S&P 500
interesting.
trending higher since December 14th, right?
Mhm.
At the same time, the VIX is kind of ever so slightly higher. So do you see the VIX movement as meaningful, or are we making this story kind of fit the narrative too nicely?
Well, I think it's worth paying attention to. I place way more emphasis on a lot of other momentum and technical indicators than the VIX. But at the same time, I think you can't ignore it. So we've seen the last few months, as you just noted, the S&P keeps working its way higher and the VIX is just creeping up. The S&P made another new high today. The VIX is comfortably above where it was a few weeks ago. Again, this is just a warning sign that I think a bout of volatility is coming. And it dovetails and somewhat supports the idea of, okay, 3 to 7% correction. That dovetails with it. So I don't make a big deal about the VIX, but at certain points in time, I think it's worth at least bringing it to the forefront, which is why I covered it in last week's weekly technical review.
Great. Okay. And then, okay, so what does all this mean for 24? You're saying a potential 3 to 7% pullback in the near term, but where do you see things going through the end of the year? And if you don't have like number predictions, that's fine. But what are you looking for? What are the things that you're looking for throughout the year?
The first real thing I think, Tony, is the evidence that the economy is in fact starting to slow, and then slowing more than expected, and it starts to raise some concerns. Because that's, as I said before, two pillars under the market. Oh, the Fed's going to cut like crazy. Okay, well, they're not going to cut like crazy, but we still have the economy. So I think evidence that the economy is slowing down will undermine a big part of the bullish narrative, and that could lead to a deeper pullback. I think there's the potential that after that pullback, which will be deeper, you could have another significant rally if we get to the point where the Fed actually is starting to cut rates. Maybe not for the right reason. Oh, inflation is down, but for the wrong reason. Oh my gosh, the economy actually needs the stimulation.
Or it's an election year.
Well, okay, I'm not in that camp, okay?
right?
And I don't think Powell is.
Oh, I don't think so either.
Okay, and one of the things I'll note, I believe people have misunderstood the Fed. Wall Street especially has thought, okay, inflation is down now, the Fed can cut aggressively. And I think, okay, that's definitely helpful. But I think the Fed's time frame is more 2 to 3 years, not the next 6 to 9 months. And the reason being is with the unemployment rate near 50-year lows, the Atlanta Fed pegs wage growth at 5%, and the overall economy growing faster than what Powell said is the non-inflationary growth rate of 1.8%. I think the Fed is looking at things like unemployment and a deeper slowdown to create enough slack in the economy so that when they do cut rates and the economy reaccelerates, inflation doesn't come back quickly in 2025, 2026.
Okay.
I mean, Powell has talked about the 1970s and avoiding the 1970s. That's, I think, in their mind, and the other patient doves on the Fed. Should we be adding stimulus at a time when the economy is doing just fine, unemployment's near a 50-year low, GDP is growing at 2.5% or better? The answer to that is no. Now, can the Fed publicly say, you know, we really need the economy to slow, meaningfully, and we want to see the unemployment rate above 4%? I mean, again, the dot plot is, the mean was 4.1, I believe, in the December plot, okay?
Mm-hmm.
But they're not publicly going to say that, especially in an election year. I mean, Powell has learned, you don't want to expose yourself and give Elizabeth Warren any opportunity to throw grenades at you.
Yep.
So I just think that this is what's behind the scenes and why there's a reluctance by a group of people on the Fed of, we don't need to hurry. The economy's okay. And we need to see this other evidence. Wall Street is not tuned in on that at all.
Right.
They think the prime determinant is just inflation.
Yep. So let's transition to the Fed. And Albert, my main question is, does the Fed have the backbone to stick with their policy? So just kind of for all of you guys, one of my main questions is this: we're at 5.5%, right? 5.25, 5.5%, right? We spent a long time, over a decade, at negative or zero interest rates. We're at 5.25, 5.5%. Mm-hmm. It's kind of a normal interest rate for normal times. So, I remember when I went to college in the early 90s, when I was an undergrad, the natural rate of unemployment at that time was 6%. I don't know if, I doubt you guys are old enough.
No, I remember. I remember. Yeah.
So 6% was the natural rate of unemployment. And now we expect 2 or something. I mean, I realize methodologies change, but come on, 2%, that's undoable, right? That's command economy type of numbers, right? And so, so my view, and I know it's an unpopular one, is 5.5% is probably kind of a normal interest rate, a normal Fed funds rate for normal times, right? Like Tracy's talking about, price of oil at 70 some bucks is above normal, right? That stuff happens when we have interest rates that, well, one of the reasons is interest rates are too low and there's too much buying, right? So I'm curious what you guys think about that at 5.5%. Have we been over conditioned to zero interest rates? I think we have, but do you think the economy would die if we stayed at 5.5%? Let me just be that dramatic at the start. Each of you guys, just a quick answer. If we stayed at 5.5%, would the economy die?
No, is my short answer. But
okay.
It depends on the duration.
Okay, well, but we can dig on that. Jim, what do you think? 5.5%. Does the economy die if we stay at 5.5%?
No, it doesn't die. Does it slow materially? Yeah.
Okay, Tracy?
You're on mute, Tracy.
Sorry. Obviously, it definitely doesn't die. We can last. We've been here before. My particular concern is this time around that higher rates are actually adding to inflation, which just then becomes a circular problem within itself, right?
When you say higher rates are adding to inflation, what do you mean by that?
Well, if we have higher interest rates, particularly when it comes to commodities, you're going to see a slowdown in production. you're going to see a slowdown because, definitely when you're talking about commodity industry, it's heavily dependent on financing these big projects, right? And especially if we're having the green transition and things of that nature, with the high cost of financing, it makes projects more difficult to get off the ground. You need higher prices on those commodities to be able to even, dig a hole in the ground. If we look at uranium, just for example, a lot of these junior miners, particularly in North America, really had to wait until like uranium hit around, $65, $70 just to get their projects off the ground.
Mhm.
They were already permitted and everything, but sitting on there because it just wasn't economical for them to go forward with plans at this point. And so that's kind of what I mean. These higher interest rates are pushing up commodities and the things that we do need. So it's kind of become a circular problem in my opinion.
Okay, that's fair. That's fair. So, Albert, obviously the Fed held rates in Jan. We just spoke a lot about the Fed with Jim, and the expectation, I would say until today, was maybe a June hike, but now after Bostic talking today, Bostic was saying 2 rate hikes this year, given the current climate. That's
Rate hikes or cuts?
Cuts. I'm sorry, rate cuts. 2 rate cuts this year.
Maybe
given the
3.
current climate.
He said.
Yeah, maybe 3 if the wind's blowing right. Okay, so we go from, I don't know, 27 or whatever people expected in December. Okay, I mean not that many, but it's crazy.
They expected 7. Market was pricing in 7 cuts.
Right, 7, right? Okay,
Yeah.
and so now we're at 2, and we've still got tech just skyrocketing, and the rest of the market is not doing great. But so what are you thinking? I mean, generally, I think Powell's done a good job holding the line. Okay, his message, he goes a little bit over hawkish in one meeting, a little bit over dovish another meeting. He doesn't quite have that Greenspan nuance. He's been in the job for a long time, so I don't think he's ever going to get it. But we saw CPI, as you mentioned, come in hot. Retail sales disappointed. UK, EU, China, Japan, all in recession. But there's immense pressure from Treasury and the White House to do something to ease, so that in an election year we look good. So
yeah, but they're already doing stealth QE right now. You know what I mean? But Yellen and her
the Treasury is the Fed isn't, but the Treasury is.
Yeah, but I mean, Janet Yellen, she was the Fed chair. She knows the plumbing and the mechanisms that Powell can use, and she's neutered him. So yeah, I give Powell all the credit he could possibly deserve, because he's there with like 1 or 2 loyalists, and the rest are all Yellen and Brainard people. So
Austin Goolsbee, the stand-up comic of the Fed.
Yeah, Goolsbee, yeah, fantastic choice there. Today's PPI number and Bostic coming out and saying what he said, just it completely killed rate cuts for me for 2024. I mean, they might do one in September just to like juice up the market if they need to, for election or whatnot. But that's about it. I mean, there's no question that inflation is sticky. No matter how much they try to manipulate the numbers out of the Treasury, the BLS, and the Fed, it's just not going their way.
Okay,
right?
So you're saying a rate cut in September. Now that is
maybe
okay, maybe rate cut in September. That's forever, right? I mean, if you're looking at markets, that's kind of forever, right?
Okay, but so what? I mean, look where we're at. We're at 5,000 something, about to hit 5,100. We're most likely going to hit 5,300 by June. Why do we have to cut? Why would they have any reason to cut rates?
It's a great question. Why? But my first question about 5.5% being kind of normal, it almost feels to me like we're being nudged into accepting 5.5%, because again, September is forever, right? That's 7-8 months. Okay. So we're gradually accepting this environment, which I think is a really good thing. It's a really good thing for us to get back to actually having a cost of money.
Yeah, we also have to remember, Tony, because Germany and the EU are completely dead and Asia's completely dead, all that money and all those inflows are coming into the United States and supporting these inflationary policies. It's helping us at the moment. So they can do this for a while. Now, if Europe comes back online for some miracle, they decide to get their act together, or China and the rest of
neither one.
Okay, they won't. Well, but I'm just saying, if they do for somehow later in the year, yeah, then we're going to have an issue. Then we probably would be cutting. But right now, I don't see any cuts. Not after these numbers in PPI. Absolutely not.
Okay, so September is forever. I mean, that's long enough for these expectations to be cemented in. And QT is still moving, right? I mean, the Fed at least is still selling off their balance sheet, right? So, we do have tightening policies at the Fed level, maybe not at the Treasury, but at the Fed at least we do, right?
Yeah, we do. But what does it matter when Yellen is pumping money into the market in other ways? I mean, it's silly. I mean, listen, if this market was being rallied because of a robust growth across, the Russell and the Dow and the Nasdaq, I would say, okay, yeah, sure, fine. But people don't care. People are just long Nasdaq. I mean, people are just long NVIDIA, right?
NVIDIA to 5,000.
They don't care. The number doesn't really matter anything. Everyone's long those like 5 or 6 stocks. So what reason does the Fed have any reason whatsoever to cut right now, especially when inflation is still a problem? No one can give me an argument to have for cuts at 5,300.
No, it's a good point, and I think it's partly because it's just been an expectation that's been set.
Yeah, and to Jim's point, like I was like, even on the show, I was saying, man, it looks like we're gonna have a recession in Q1 of 2024, maybe a little bit. No, it's just that time is just elongated. It's gone. It's probably until like 2025 at this point, for a real recession, just because of the antics of the Fed and the Treasury right now. So I don't see why we need cuts.
Right. I just keep hearing no one expects the Spanish Inquisition, right? I mean, these things happen when we don't expect them.
I mean, yeah, but Tony, it's like those 7 rate cuts that they were pricing in was just absurd.
That was ridiculous.
It was absurd.
Yeah, but people bought it, right? And it drove up markets in Jan. So it was enough to sell, into markets then, and retail at least bought into it. A lot of portfolio managers sold in December and Jan, but retail certainly bought into it, right?
Yeah, nobody cares about retail anymore. I mean, this is mainly just big funds driving things right on dealers and whatnot. So it's like, it's just silly. We're in a silly world right now.
Yep. So, okay. So to my question, does the Fed have the backbone to persist with their strong policy? Their relatively hawkish policy? You say yes.
Yes, they do. Yes, they do. Only because, mainly because the inflationary numbers, CPI and PPI, keep coming in higher. That's it. They have all the justification they need, so they don't need a backbone per se. They have the justification to stay higher for longer.
Okay, great. Jim, what do you think about that? Do you think they have the backbone?
Yeah, until the data starts to soften. The one thing I'll point out is in the September meeting, the high dot and low dot, the spread was 25 basis points. At the December meeting, it was 150. So my point and what I've been writing is you've got 2 groups now on the FOMC. You've got the doves who are looking at the real funds rate and saying it's restrictive, and as inflation drops more, it becomes more restrictive. So they're on, hey, let's cut the funds rate. And then the patient doves are, no, we can wait. So to me, Powell's job has been complicated a little bit by that division that didn't exist previously. I think with the inflation rate coming down as much as it has, the Fed is just waiting for economic data to begin to slow. And then I think, okay, they're definitely going to throw a bone to the doves. Okay, let's cut the funds rate 25 basis points. If another month or two or meeting or two goes by and there's even more slowing, there will be another cut.
So what's slowing, Jim? I mean, inflation's slowing, but CPI, PPI, GDP, these are all strong numbers. Whether they're real or not is immaterial. That's what's published, right? And so they can always point to those numbers and go, hey, those are strong and jobs are strong. At least the jobs numbers that are coming out are strong, right? And so, they can point to those things that are their mandate and say, hey, we're fulfilling our mandate. I don't understand why we have to change policy.
Again, I believe that they're looking for more weakness, and that if and when it starts to show up, the patient hawks will be like, okay, now it's warranted for us to take a small step toward easing, and they do a 25 basis point cut. I have no idea if that's May, June, July, September. Again, I'm looking at it and just saying, I think a slowdown's coming. When it does materialize, the decline that we've seen in inflation provides them the flexibility to respond maybe a little more quickly to signs that the economy is slowing. Are they going to do it aggressively? I doubt they're going to do it commensurate to the amount of slowing we see.
Yeah, I'm with you.
And that to me is the only way to play this. The one thing I'll point out, okay, I use technical analysis a lot. You can tell I, focus on the economy and other good stuff. The Treasury bonds sold off from their high of March of 2020 to the low last October in 5 waves. Very distinct. So last October, I said it was time to buy Treasury bonds because after a 5-wave decline, you're going to get a fairly significant retracement. TLT was around 84. I think it can go to 105, 109 with an outside chance of 119. That only happens if the economy really slows. So I discussed this in the February macro ties. I kind of went into a lot of detail of how you use technical analysis with fundamental to kind of come up with a higher conviction expectation. So the point of that 5-wave decline is it, in my mind, it signals the end of the secular bull market that bonds have been in from 1981 to 2020. We are now starting a new secular bear market. And if you look at retracement levels of the decline in the 10-year, you're talking 7.5%, 8% conservatively. So my point is, if we get a recession, the Fed is going to respond. They're going to cut rates. That's how TLT can maybe get up to those upside targets.
Right.
But then you're going to have an avalanche of supply from the Treasury because knowing Congress, they'll ramp up spending higher than it already is. And I think the markets choke on that supply. And we saw the first hints of that in September, October, where there were 2 auctions that hardly anybody showed up. And Treasury yields jumped by 50 basis points into their high in October. So to me, that is one of the dynamics of why I believe a secular bear market in equities is not too far off, because I think a secular bear market in bonds, Treasury bonds, has already begun. We're just in this retracement rally based on, okay, we're going to see weakness. And after that, then I think Katie barred the door, so that's kind of the bigger picture view, if you will.
Right. I love your optimism. Tracy, what do you think about the Fed? Do you think they have the backbone to stick with their policy?
Well, what I thought was interesting is that Powell never wavered from his stance higher for longer, right? Until that December meeting, which is like a 180.
Yeah,
and
so weird.
And one has to wonder why they said that. Was that, did they get a good talking to from the administration saying, hey, we're heading into an election year? You gotta, I don't know what happened, because before that meeting, I would have said, Powell's, I don't care what you guys think. Powell's been adamant in his stance higher for longer. And it was that December meeting that was just a very strange shift in rhetoric.
Can I interject for 1 second? Because I know that that's how most people responded, Tracy, and I get it. At the same time, if you look at his prepared statement, which was undoubtedly written the day before, if not sooner, because they meet Tuesday, Wednesday, the presser's on Wednesday. His prepared statement repeated points he had made for months and months and months about labor. Yeah, market tightness is easing, but the labor market's still tight. All that stuff, right? Now, what he pointed out during the presser is that the day before you had the CPI, that morning you had the PPI, and they encourage FOMC members to change their dot plot projections up to mid-morning or later on that Wednesday. So all of a sudden, like I said, in September, you had a 25 basis point spread between the highest and lowest dot. December it was 150. I think it's reasonable to believe that, okay, after the CPI and PPI came out for November, and they were, good numbers, that some of the doves, a la Goolsby, maybe Mary Daly, I'm changing my dots, man. I think the funds rate should be down at 4 3/8, whatever, I can't remember the number precisely. I think Powell was blindsided, because if he really had done a 180, his prepared remarks would have been different, and they weren't. But he's dealt with, whoa, wait a second. All of a sudden the dot plot comes out, and there's a lot more dovishness there than I anticipated when I wrote my remarks. And that's where I came up with the idea. You got two groups. You got the doves and you got the patient hawks. And I have continued to believe that Powell's in the patient hawk camp. And I think that January 31st reaffirmed that. And so again, well, I've been amazed the last 2-3 years how wrong Wall Street and perceptions have been about the Fed. In January of 22, Powell said inflation represents a severe threat. Now, any of us are confronted with a severe threat. Do you kind of casually walk away, or do you turn and hightail it out of there, right? In January of 22, Powell had already said inflation wasn't transitory, and yet the Fed funds futures were pricing in 3 rate hikes for all of 2022. Goldman Sachs, 3 quarter-point increases for all of 22. So my point is, this has been consistent, that these folks do such shallow analysis that they don't really get monetary policy. And I get it. They weren't around for a 40-year high in inflation. They've only known a dovish Fed, and they just assume that this is the way it's going to go. If you look at the Fed funds future relative to what it actually did, you saw all these people, well, they're going to stop at 3. Oh, they're going to stop at 3.5. I mean, So my point is, if, I read his comments literally, and I break them down. And for me, it was like, folks, he didn't do a 180. He said exactly what he's been saying. If you look at his statement, he then was presented with a circumstance where all of a sudden the dot plots were much more dovish than he expected. And again, I think what we saw and what we've seen in speeches, even Goolsby has kind of like, okay, a little longer is okay, but I still think we should be cutting rates.
I just have to say, I love how much we're slamming Austin Goolsby in this show. Great.
I'm surprised somebody hasn't called him Foolsby, but we don't want to go there.
Jim, I also think, your problem is that you actually read the statements and you don't just take Twitter hot takes on Fed,
It's a real liability.
Because it is, like, knowledge is a problem. So Tracy,
it's critical thinking, Tony, and we live unfortunately at a time.
Stop. Critical thinking is not acceptable here.
Yeah, everything's this way or that way, and it's extreme.
Yep.
And the idea of really digesting and thinking about stuff, because listen, I listened to all these people say he did a 180, oh my God. And then when I said, wait a second, he didn't say anything different in his statement. When would he have written that, and so forth? So again, they're paranoid about the 1970s. And to the extent that there could be geopolitical risks that do drive oil prices higher, I don't think they're oblivious to that either. So
they're not stupid.
They're trying hard. It's, as you said, we're something about like we're trying to forecast in a cloudy sky, or he's right. He's a pretty humble guy.
Yeah, but their forecasts are pretty bad. I mean, there's no way around it. Their forecasts are terrible.
Yeah. David Rosenberg, a couple of years ago, went back, I don't know how many years, looking at their forecast for Fed funds, GDP, unemployment, inflation. Yep. They were right less than 1/3 of the time.
Of course.
And you think about that. Wait a second. They control the funds rate.
Yep. Yep.
So
we've got to move on to Tracy. And Tracy, I think that we've had so much rosy talk so far in the show. We've got to talk about Natgas and difficulties in the Natgas market. You and I talked through Natgas and geopolitics last week, but prices just seem to be going lower. We saw the current price levels are equivalent to what we saw in 2020, but we haven't, prior to 2020, we haven't seen these levels since like 1999. And we're kind of 2% above 1991 levels right now. So why are we seeing this? Is it a warm winter? Is it circumvention of Russian export restrictions? Is it Biden's gas export restrictions? Why are we seeing this in nat gas markets right now?
Well, first of all, we're seeing, I think we had a knee-jerk reaction in 2022 because literally we had Europe have to change their complete supply chain, right? So gas markets panicked, but that's not the norm. I mean, there is plenty of nat gas for right now in the market, particularly in the United States, and this is kind of, we are a little bit below the norm, but $2 is kind of the norm. So as they say, the cure for low prices is low prices. And what we have seen from companies this week, nat gas companies this week, as far as earnings were concerned, you had Comstock Resources, Antero Resources, even EQT say, we're cutting back our production next year. That's what they said in, Q4. We're cutting back our production. We're cutting back rigs because it's just not economical. So, I think that this will take time to obviously filter down into the market. And so, it wouldn't surprise me if we just kind of skidded along this $1.52 range until we really see a change in policy. And of course, Biden saying we're going to pause on export licenses didn't help, right? Because that does not help, move product out of the US.
Right.
And so I think the market's also waiting on that for right now. But again, we are starting to see companies come out and say, we just can't produce as much as we have, we're cutting back. But that's gonna take a few months for the market to really see this occurring.
Okay, I don't really pay attention to nat gas production levels. Are our production levels way above what they were, say, 2 years ago?
No, I mean, they're higher. Yeah, they're higher because what's happening with shale wells is they're getting gassier and gassier as you're getting away from your kind of tier 1 acreage, right? And so we can get more oil out of this, but when you start getting to scraping the bottom of the barrel, so to speak, what comes out is a lot of gas. So, and those products really can only be used for either have to flare it, especially if you're just a solid oil company, what are you going to do with it? Or you sell it to chemical companies. And that's really all that you can do with what's coming out of those wells right now. And so we're getting, shale wells are getting gassier and gassier because we're not spending on infrastructure. We've talked about this before. We've seen all these mergers because companies are buying capacity instead of building capacity, right? And so they're buying production, in other words. And so we have a lot of product right now, and, having the administration kind of put a snag, so to speak, and that is, was very difficult for the market to swallow. But, I do think that, again, like I said, cure for low prices is low prices. And so I do think we'll see a cutback in that.
Okay, so what are we seeing in terms of the capacity to export to Europe? Do we have enough capacity? Do we have enough vessels? Do we have enough export locations to export to provide what Europe needs?
I think immediately, yes. In the short term, out to 2026, all the projects that have already been permitted, that have already had, acceptance from FERC and they're ready to go, will still go ahead.
Okay.
Biden pauses really affect, the largest projects, unfortunately, in Louisiana. And so export capacity build out after 2026. For the next couple of years, it's fine, we're fine.
Okay.
It's just looking out past that and, do these pauses push out those timelines that have already been put in place is another problem.
Okay. I want to ask a couple of dumb questions. So the export terminals for exports to Europe, are those mostly Texas, Louisiana, or are those other places?
Mostly Texas, Louisiana.
Okay. And then the export to, say, China, because we provide, I think, 21% or something of China's LNG. Is that Texas and Louisiana as well?
Texas and Louisiana.
Okay. And do those gas wells, do they get shut down for maintenance like refineries do, or do they just Or are they just kind of evergreen?
No, they're just gas wells. Are you talking about the gasification, if you're talking about gas going to an LNG facility, right? Which super cools it, makes it into a liquid, then it's put on a boat because it's easier to ship that way.
Right.
And then sent to Europe or wherever, and then it's regasified. So then they turn it into natural gas again from LNG. And
Right.
so right now, but those LNG facilities don't have refinery maintenance season.
They don't.
Right.
So, okay, so they just work and maybe occasionally they
They
shut
work.
down.
And they have of course they'll have problems. We've had
Yeah.
problems, that's an
Everything.
issue, that they're not on a traditional maintenance schedule.
Yeah. Okay. So if you're an energy investor right now and you're looking at where LNG prices are, what are you thinking about in terms of investment?
Well, I think that, I think this market, it's called the widowmaker for a reason. But I think what we're probably going to see, everybody's been trying to buy this since since it reached $2. And my only thing is looking at this market can skid along the bottom of this price range for a lot longer than you think it can. Has been my experience. So,
Okay.
I know everybody's out there trying to buy this.
Yep.
And like with these double and triple levered ETFs, which scares the heck out of me. So just know that this market, can skid along this price range much longer than you think.
Yep. Yep. That's good. That's a good call. Be very careful. So again, when I look at the charts, I'm like, holy cow, it's as low as it's been.
And you want to buy it, right? It looks
Right.
viable.
Right.
It does, but like I said, I'm just a cautionary tale, and especially if you're in these ETFs, because these ETFs roll those futures contracts, and you get screwed, so to speak, on the roll every time these, double and triple lever ETFs roll. So in other words, you're trying to play catch up the whole time. So just be careful with those.
Good. Thank you.
That's a great point, Tracy, and it affects not just the double and triples. It's funny you mentioned this because earlier this week I was looking at UNG, and they have internal issues too as they roll contracts, and I was somewhat incredulous. The high on UNG, I believe, was 7,800. I can't remember. Where's it trading now? Is it like 30 or something? So the point is, if you stake out a position in these products with a long-term view, you're going to have to be 3 times right just to make some money.
Correct.
So that's a great point, because I think a lot of people don't fully comprehend that risk.
Great. Very smart risk management. Albert, what do you have to say about energy markets right now? What are you watching?
Fertilizer, really, more than anything else, but that relates to Natgas because they're kind of tied together. But that's where I'm looking at right now. I want to see a move in fertilizer probably into the spring.
Okay, so you're looking for upward movement for
upward movement. Yeah.
Okay. Is that seasonal or is that some sort of market?
It's seasonal, but also it's an election year and farmers are going to get subsidies and they need tractors and fertilizer and all those good things. So that's what my play is.
Good to know. Guys, this has been fantastic. I'm so grateful for your time and I really appreciate this. Have a great weekend and have a great weekend. Thanks a lot.
Thank you.
Thanks, guys.